Felix here, and in the first half of 2023, corporate bankruptcies are up 93% from last year. 93%. I'm going to explain to you what that does to the stock market and how I trade it. But first, you deserve to understand how hedge funds actually set up trades with an 85% probability of winning, and I'm going to teach you that strategy for free. Not in this video, it takes too long, but sign up at felixfriends.org/webinar. There are still about 100 spots or 80 or so available. Grab one of those on Tuesday the 11th. In just 2 days, I'll be teaching you the entire strategy. We'll do some live trading together as well so you can see exactly how to put it into practice. Now, back to the juicy stuff. Year to date, 15 companies with over $1 billion in liability went into bankruptcies. And on top of that, obviously lots and lots of smaller ones. Now, normally, the worst bankruptcies come 1 or 2 years into a recession, but this time they're happening right before a recession. It's hard to imagine the recession out there with the beautiful flowers behind me, isn't it? But I think it's happening. So why do we get these bankruptcies before the recession is official? Well, banks basically aren't lending. The banks are shutting the doors, battening down the hatches even, not the hedges. And we're in a credit crunch. And in a credit crunch where, struggling with the words today, where lenders cut off lending to healthy businesses, jobs go, investment goes. Now, what about the stock market? Is it all doom and gloom? No, it's not. But if you look at central bank balance sheets, and I don't just mean the Fed, but all central bank balance sheets in the world, and I'll put a little image up here somewhere so you can see it, and, well, they're shredding money. After an extraordinary experiment of printing money, they're now shredding money, and there is a 98% correlation between the S&P and central bank balance sheets. And what does that mean? It means if central bank balance sheets go down $1, the S&P goes down 98.5 cents. That's basically how strong that correlation is, which is pretty crazy. At the same time, if you look at interest rates, they've shot up like mad. If you go back to 2002, 2003, 2004, 2005, 2006, when interest rates were going up, well, what happened? Suddenly, job openings disappeared. Suddenly, unemployment went up. There's a little blue chart here, I'll pop that out as well, which is a little blue line, which is US job openings divided by unemployment. And then in white, you've got the Fed's interest rate. So they're starting to come down a little bit. Now, the danger is that when they start to come down, they typically come down very, very rapidly. So it's a lot of momentum. It's a lot of emotion. People put off the firing. But when they do start, they'll do it with a vengeance. What about the next thing? Try to cheer you up here on a Sunday. Don't worry, there'll be something positive here at the end. Well, the easy AI trade is also over because everything with the AI vaguely attached to it has gone up a lot. From here to go up much, much further is much more tricky. So somebody asked me that today, well, should I buy Microsoft? And I said, well, I can't tell you. That's financial advice. The regulators make that illegal for me to comment on that. But what I can say to you is that I would favor DCAing into great companies over a really long period of time so that you're not just buying at the top of the market. That's generally speaking, statistically the best way to do it. But before I get you all depressed and all bearish and everything else, and I have some punishment at the end of this, I'll tell you about that as well. US economic data is coming in surprisingly positive. Each bit of economic data of late is surprising us in a positive sense. Positive surprises generally are very supportive for the S&Ps. There's another correlation there. See, one data piece never tells you the full story. I've got a bug crawling on me. Now, how do we trade this? I'd say it's a stock picker's market. I would say it's a short-term trader's market. I think trades within a 3 week time for a frame are reasonable to set up. I think we got some really nice, clear charts where we get some really good opportunities where we can make some nice returns in a couple of weeks with limited downsides, everything always hedged, and we can make money. I think anything else is not advisable. That's what I would say. Now, what's my punishment? Well, this bug is still on my hand. The punishment is 1 hour leg day. I can't put it off any longer. So I'm going to torture myself. Why do I torture myself? Because I enjoy the increased fitness I would get from it. It makes hiking much more fun. It makes climbing mountains much more fun. So sometimes you have to get through something to get the real benefit out afterwards. And I'm a big fan of doing that every day. I work out every single day relentlessly. And if you do it, I put a little reel today that said, if you do anything for 100 hours in a year, you'll be in the top 5% of people that for that skill. So if you want to be one of the top 5% of investors in the world, all you got to do is spend 100 hours a year becoming a great investor. That's 18 minutes a day. Maybe thinking, I'm 80 minutes a day. Well, you watch social media for more than 80 minutes a day. Otherwise, you wouldn't be at the end of this video. Now you're watching obviously something very, very valuable. But yeah, that's what I'd say to you. It's like you just got to focus, and for that you have to have a clear target. Once you have that clear target, you will keep doing it, and it's actually kind of fun. I mean, I don't really enjoy the leg days. I really, really don't. They're much more fun exercises that I'd like to do, but I know I need to do it. There's such a benefit from it, and if I don't do it, I'll suffer. So I'm going to voluntarily induce some suffering for myself now. I wish you a beautiful day. If you enjoy the video, hit the subscribe button to appreciate it. Appreciate this community growing so much, and I wish you a fantastic day wherever you are.